Hello my dear friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will be discussing about reforming the PSU banks, that is public sector undertaking banks, those banks that are owned by the government beyond recapitalization. So recapitalization means that the government is infusing an additional capital into the public sector banks. So beyond recapitalization, that is apart from recapitalization, what has to be done in order to reform the public sector banks? So this is what we will discuss in this lecture. So the background of this lecture is that recently in the Union Budget of 2019, government has proposed an additional recapitalization package for the public sector banks. We will discuss all this in detail. We will also see apart from recapitalization what is required and what are the measures that should be taken in order to revamp the banking sector in India. Now let us first look into the current affair. So if we analyze the current affair, we will see that the Union government through the budget 2019 has allocated an additional 70,000 crore for the recapitalization of public sector banks. Now if we look at a few months back, the government had infused capital into the public sector banks through recapitalization packages. So what is meant by a recapitalization package? A recapitalization package means that the government is infusing additional capital, additional liquidity into the public sector banks. Public sector banks are those banks that are owned by the government. Now, if we look at the prompt corrective action framework of RBI, 11 public sector banks were put under the prompt corrective action framework. And after the government infused capital through recapitalization plans, certain banks who were in the PCF framework or the prompt corrective action framework of RBI was able to come out of this. So this is to help the banks in order to overcome their liquidity crisis and also to maintain their minimum requirements in terms of capital adequacy ratio and also in terms of NPA. So the government infused in additional capital to help the public sector banks, and this is what is called recapitalization package. So here in the Union Budget, the government has announced that apart from the previous recapitalization packages, an additional 70,000 crore rupees would be infused into the banking system, into the public sector banks in the country to help them come out of their financial crisis or their liquidity crisis. So this is the current affair. So I hope you have understood what is the current affair, and based on this current affair, we will analyze whether recapitalization is enough to help the banks or what more has to be done to help the banks, especially the public sector banks, to come out of their liquidity crisis. So let us come to plan of the government. What is the plan of the Union government? So if we analyze the plan, we will see that it is based on RBI's financial stability report. So RBI's financial stability report was recently released in the month of June, and we have already covered the portion in a different lecture. You can refer to the video on financial stability report of RBI in order to get more understanding about this topic. So based on RBI's financial stability report, the government has taken certain decisions. So let us briefly understand what are the highlights of the financial stability report of RBI. First, if we talk about the NPA, that is non-performing assets in the banking sector. So non-performing assets are those assets or those loans for which the interest or the principal amount is not paid for more than 90 days. And this is called non-performing assets. And NPA crisis is one major crisis in the banking sector in India. So if we look at the NPA crisis, according to the financial stability report, the banks, especially the public sector banks, have improved their performance with regard to their NPAs or GNPA, gross non-performing assets. So this was first highlight. Second one is regarding IBC, that is Insolvency and Bankruptcy Code. So the application of Insolvency and Bankruptcy Code has also helped the banks to recover from their NPAs. So this has also helped to a larger extent, and this is another highlight of the financial stability report of the RBI. Now third one is regarding the bank credit, that is the quantum of credit or the capital the banks were able to provide. So this refers to the money supply of the banks. So the quantum of bank credit has also shown a significant growth. So this was due to various policies of the central government, that is fiscal policies plus the monetary policy adopted by the RBI. So RBI has adopted a stance where the interest rates have been reduced, that is the benchmark interest rates, that is repo rates have been reduced, thereby enabling the banks to raise more capital from RBI and to provide cheaper credits to the general public. So this will help to raise or to increase the bank credit growth. So these are the three important highlights of the financial stability report that we should consider for this lecture, for this topic. Apart from this, I have discussed all the important highlights of the financial stability report in a different lecture which will be available on our channel StudyIQ. So you can refer to the lecture if you want to know more about the financial stability report, and this is a very important topic for any competitive examination point of view. So this is regarding highlights of the financial stability report, and based on these indicators, the government has decided to allocate an additional capital of 70,000 crore into the banking system, into the public sector banks in India. So this is the plan of the government. Now let us understand what are the expected outcomes and also what are the expected concerns in this regard. So first one is regarding expected outcomes. The expected outcome is that there will be a significant capital growth. So we will see what is meant by this capital growth. Now the government is infusing more capital into the public sector banks. That means now the public sector banks have more money to lend to the general public. Their financial position will improve. So when the financial position of a public sector bank improves, it indicates that the bank is able to lend more money to general public. Thereby there will be a capital growth. So there will be more lending by the bank. The general public will be able to raise more capital from the banks. Thereby the money supply will increase. The capital in the economy will increase. This will further boost investments. And with this investments, the output or the GDP will increase, and thereby there will be economic growth. So this is the first indication and this is the expected outcome. So by recapitalizing the public sector banks, the government is revamping the banking sector, especially the public sector banks, thereby enabling the banks to provide an additional capital to the general public, thereby indicating a capital growth in the economy. So this is the outcome. Now let us understand what are the concerns. So here the major concerns raised is that reforms are expected instead of recapitalization. So here what is meant by reforms? We have already seen what is recapitalization. So recapitalization means government is infusing an additional capital into the banking ecosystem or to the public sector banks. But reforms is a broader concept. So here reforms is broader in the sense that it includes not only recapitalization but additional structural reforms or structural changes, operational reforms in the banking sector. So it is criticized that instead of recapitalizing the banking sector, the government should undertake structural reforms or structural changes to revamp the banking sector. So this is the criticism. So let us understand this in detail later in this lecture itself. Now let us come to the criticism. Let us analyze it in detail and let us understand what are the measures needed. Instead of recapitalization or apart from recapitalization, what more measures are needed or what more measures are expected from the government. The first one is to improve the operational efficiency of the public sector banks. So by improving the operational efficiency, the profitability of the banks will improve, and also the efficiency or the performance levels of the banks will improve. So this is the first expected measure from the government. Second measure is to do away with the dual control. That is, now the public sector banks are controlled or regulated by both RBI as well as the central government by the finance ministry. So now there is a dual control over the public sector banks. So this has to be done away with. So either the RBI or the finance ministry should take the control of the public sector banks, and it should ideally fall within the RBI, because RBI is the monetary head or the regulator of the financial system, the banking system in the economy. So it should ideally fall within the RBI, and the finance ministry should do away with the control or the regulation over this public sector banks. So this is the second expected measure from the government. Now third one is that the public sector banks should be put par with the private banks. This is in terms of regulation, in terms of control, etc. So the same level of regulation and control that are applicable to the private sector banks should be applied for the public sector banks itself. So this will give them enough space to make their own decisions and also to operate within their efficiency and capacity. Now third measure is to improve the manpower in the public sector banks. That is to recruit manpower with specialized skills, and this manpower should also be given independence or operational independence to take their own decisions. And fourth one is linked with the manpower, that is the wages or the salaries given to this manpower should be linked with market and performance. This is how the private sector banks perform. If you consider any private sector banks, for the managers or for the top management or even to the lower levels, the salaries are performance based and also market based. So this should be the case with public sector banks also. So the performance or the efficiency of the manpower in the public sector banks will improve if the salary or the wages are linked with the market and also linked with their own performance. Now the next measure is that the government should bring down the shareholding of the government in the public sector banks. So public sector banks means those banks for which the majority of the shares are held by the government, the union government. So the government should bring down the government shareholding. This is a kind of disinvestment or a privatization. So government should bring down its shareholding so that the control and the regulation of the government in these banks will come down. They will get enough space and operational efficiency to take their own decisions, and also their profitability and the efficiency will also improve. So these are the measures that are required apart from recapitalization of the public sector banks. So we can say that apart from recapitalization, structural and operational reforms are what are required in the public sector banks, and this will make a significant change in the functioning of the banking sector in the Indian economy and will revamp the banking sector. So I hope you have understood the topic that I have tried to explain to you today. See you with another topic. Thank you.